Good day, everyone. Welcome back to Introduction to Financial Accounting 2. Welcome back to this last and final lecture of this course. This lecture is going to look at Chapter 17, which is titled Statement of Cash Flows. We are going to focus on three main learning objectives in this lecture. First, we'll try to discuss the usefulness and format of the Statement of Cash Flows. Two, we're going to prepare a statement of cash flows using the indirect method. And finally, we'll try to learn how to analyze the statement of cash flows. So let's get started. First, let's see why is it important to use cash flow statements and what kind of information they convey. The cash flow statement provides a picture of the company's cash flows. It shows us the company's ability to generate future cash flows, their ability to pay dividends and meet obligations. And through the statement of cash flows, we can also understand few key information about the company by looking at the differences between the net income statements and the net cash flow that is provided by the operating activities that would be shown on the statement of cash flows. We could also see the investing and financing transactions that the company got into during a specific financial period. So these are the main key points that provides for the importance of the statement of cash flows. Now, statements of cash flows are generally classified into three categories: the operating activities, the investing activities, and the financing activities. On the operating activities, it's pretty much an income statement, and it reflects the income statement items. And then on the investing activities, we can see changes in the investments and long-term asset items. And on the financing activities, we can see changes in the long-term liabilities and stockholders' equity items that relate to the company. Let's start with the operating activities first. Now, on the operating activities, as we mentioned, we can see income statement items, and those, of course, are broken into two groups: the inflows and the outflows. So in the cash inflows, we're going to see inflows that are generated from sales of goods or services and from interest received and dividends received received by the company. On the outflows side, we can see money that was paid out to suppliers for inventory, or to employees for wages, to the government for taxation purposes, to lenders for interest, and to others for some other expenses. The second class, which is the investing activities, as we mentioned, it focuses on the changes in investments and long-term assets. Now on the inflows side, we can see cash inflows from sale of property, plant and equipment, PPE. Remember, we studied those in chapter 10. And from the sale of investments in debt or equity securities of other entities, or from collection of principal on loans to other entities. On the outflow side, however, we can see the cash outflows that went out to purchase property, plant, and equipment, or to purchase investments in debt or equity securities of other entities, and to make loans to other entities as well. Finally, in the last section, we have the financing activities, which, as we mentioned, focuses on changes in long-term liabilities and stockholders' equity. Now, for this one, the cash inflows would be from sale of common stock or from issuance of debt, such as bonds and notes. And on the cash outflows side, it would be from, or it would go out to stockholders as dividends, or to redeem long-term debt or require capital stock or treasury stock. Um, so that is the three sections of the or the three classifications of a cash flow statement and the types of accounts that you would typically expect to find or to use in each of these sections. And then we have a category that relates to the cash flow statement, but usually isn't um, reported on the cash flow statement um, per se, but it could be in either a separate schedule on the bottom of the financial or on the cash flow statement, or in a note in the notes to the financial statements. Um, this includes what is called non-cash activities, and some of the most commonly used non-cash activities include direct issuance of common stock to purchase assets, or the conversion of bonds into common stock for convertible bonds that we covered in the last chapter, and an issuance of debt to purchase assets, or exchanges of plant assets, meaning exchanging one plant asset for another without having cash in the middle of this transaction. Now let's look at how statements of cash flows are formatted. Now the order of presentation is the order of mentioning the classifications that we listed before. So you would start with the operating activities first, and then you move on to investing activities, and finally financing activities, and then you close um, uh, the cash flow statement by figuring out the net change in cash, whether that was an increase or decrease in cash flow, and you add the beginning balance of the cash flow, and that will give you the ending balance of your cash flows at the end. Here's what a statement of cash flows typically would look like. This is the illustration that you could also find in your textbook that shows the format or an example format of a statement of cash flows. So as we mentioned, notice how you have the first classification first, cash flows from operating activities, and then the cash flows from investing activities, cash flows from financing activities, and then we have net increase or decrease in cash. And then we add that to the cash at the beginning of the period, and that will give us cash at the end of the period. And at the bottom, we can also add non-cash investing and financing activities, just as we mentioned earlier. Here is a do-it-yourself exercise that relates to the first learning outcome in today's lecture. Feel free to pause the video and give it a go. Moving on to the second learning objective, we're going to try to prepare a statement of cash flows using the indirect method. To prepare a statement of cash flows, we need to collect information, and the three main sources of information that we're going to depend on to create a statement of cash flow is the comparative balance sheets, the current income statement, and some additional information that you might not find on those two financial reports. The process of preparing the statement of cash flows goes through three major steps. The first one is to determine the net cash provided or used by operating activities by converting net income from an accrual basis to cash basis, right? If you remember that we talked in accounting 1 about the differences between accrual basis accounting and cash basis accounting. So this is what this specific step entails. So it involves analyzing not only the current year's income statement, but also comparative balance sheets and selected additional data. The second major step would be to analyze changes in non-current asset and liability accounts and record as investing and financing activities, or disclose as non-cash transactions. Now, this step involves analyzing comparative balance sheet data and selected additional information for their effects on cash specifically. So remember, you're only dealing with transactions that have a direct impact on your company's cash. The last major step here would be to compare the net changes in cash on the statement of cash flows with the changes in the cash account reported on the balance sheet to make sure the amounts match. Okay, so the difference between the beginning and ending cash balances can be easily computed from comparative balance sheets. So you'll take the previous year's cash flow, compare it to this year's cash flow, and what you want to find out is the difference between the two. Now remember, the last three steps we mentioned relate to the indirect method of creating a statement of cash flows. Companies typically favor the indirect method for two reasons. They are easier and less costly to prepare, and they focus on differences between net income and net cash flow from operating activities. Here we're going to go through an example to try to practice and see how the indirect method works and how we can use it to create a statement of cash flows. So we have this company called Computer Services Company, and as you can see here on this slide, we have their income statement for the month ended December 31st, 2017. Typical income statement, we have the sales revenue, cost of goods sold, operating expenses, depreciation expenses, loss on disposal of equipment, interest expense, and then we have the income before income tax and the income tax expense, and finally we have the bottom line, the net income. So these are the details that we can get from the income statement of this company. And on here we have the company's comparative balance sheets. So notice we have the balance sheet, but we don't have the information for 1 year only. We have 2 years details. So the year that we're working with it, which is 2017, but we also have the values for each account, or the balances for each account from the previous year as well. This is what we call a comparative report, because it will help us figure out the changes or the difference between the balance of each account between the 2 years easily and quickly without having to shuffle between multiple reports. And on here we have a continuation of the comparative balance sheet. We have the liabilities and stockholders equity section, and notice on the bottom we also have some additional information for 2017. We have 6 key points. The first one, depreciation expense, was comprised of 6,000 for building and 3,000 for equipment. Number 2, the company sold equipment with a book value of 7,000. The cost was 8,000 less accumulated depreciation of 1,000 for 4,000 cash only. Number 3, they issued 110,000 for long-term bonds in direct exchange for a land. Number 4, a building costing 120,000 was purchased for cash. Equipment costing 25,000 was also purchased for cash. 5, issued common stock for 20,000 cash. And finally, number 6, the company declared and paid a 29,000 cash dividend. So let's begin creating our statement of cash flows. We'll start with the first step, of course, with the operating activities. We want to determine the net cash provided or used by operating activities by converting net income from accrual basis to cash basis. So these include some adjustments that you're going to need to do or to perform on the net income, such as adding back non-cash expenses such as depreciation, amortization, or depletion expenses. Because remember, these kinds of expenses are not actual cash that is paid out by the company, right? We will deduct gains and add losses, and finally analyze changes in non-cash current asset and current liability accounts. So first, let's add back depreciation. Remember, as I mentioned in the previous slide, although depreciation expense reduces net income, it does not have an effect on cash, right? So the company must add it back to their net income. So we'll take the cash flows from operating activities section. We will put in the net income, which we got from the income statement at 145,000. The adjustments to reconcile net income to net cash provided by operating activities is to add back depreciation expense. In this case, the total depreciation expense we had was 9,000, so we're going to add that back, and that will give us net cash provided by operating activities. Then, as you might remember from the notes that we had, that the company have sold or disposed of an equipment for a loss. So what do we do in that case? Companies report the or the loss on disposal of equipment. The companies report as a source of cash in the investing activities section the actual amount of cash received from the sale. So in that scenario, any loss on disposal is added to net income in the operating section, and in the case of a gain on disposal, it will be deducted from net income in the operating section. So let's see how is that going to affect our specific example in the following slide. Of course, for our specific example, we had a loss on disposal of equipment, so we're going to add that back to the net income. So again, same details we had from the previous steps. Now what we're going to do, we're just going to also include the loss on disposal of equipment, and we're going to add the amount to our total from before, and that will adjust our net cash provided by operating activities up to 157,000. Then let's see how do we deal with changes to non-cash current assets. So when the accounts receivable balance decreases, the cash receipts are higher than revenue earned under the accrual basis. So here we have an illustration that shows you the ledger account that relates to the accounts receivable account and its balance. And here we have the opening balance being 30,000, and we had some receipts from customers, or we had some more accounts receivable from our sales of 507, and then we received from customers 517,000. So that brings the closing balance of our accounts receivable account to 20,000 balance, meaning that the company have received more in this specific financial period. So the company is going to add to net income the amount of the decrease in their accounts receivable. So going back to what we have done so far in our statements, everything is going to stay as it is, but we're going to add the decrease in accounts receivable of 10,000, and that is going to adjust our net cash provided by operating activities up to $167,000. And now let's see how can we handle another non-cash current assets, in this case inventory. So when the inventory balance increases, the cost of merchandise purchased exceeds the cost of goods sold. And the cost of goods sold does not reflect cash payments made for merchandise, so the company deducts from net income at this inventory increase. So let's do this. Let's go back to our statement of cash flows in the following slide. So now we'll take the increase in inventory, which was 5,000, and we're going to deduct it from our cash flows from operating activities, and that will give us net cash provided by operating activities dropping down by 5,000 down to $162,000. When it comes to prepaid expense balance increases, the cash paid for expenses is higher than expenses reported on an accrual basis, so the company deducts the decrease from net income to arrive to the net cash provided by operating activities. So if the prepaid expenses decrease, reported expenses are higher than the expenses paid. So how is that going to affect our calculations so far, or our statements? We're going to deduct the increase in prepaid expenses, which was 4,000 in our example, from the cash flows from operating activities, and that is also going to bring our net cash provided by operating activities down to $158,000. Now moving on to changes in current liabilities. Um, Here we're gonna start with accounts payable. So when accounts payable increase, the company received more in goods than it actually paid for. So the increase is added to net income to determine net cash provided by operating activities. And when it comes to income tax payable decreases, the income tax expense reported on the income statement was less than the amount of taxes paid during the period. So the decrease is subtracted from or deducted from net income to determine net cash provided by operating activities. So let's see how these two items or those two adjustments going to reflect in our statement in the following slide. As we mentioned in the previous slide, we're going to take the increase in accounts payable and add it back to the cash flows from operating activities. And we're going to take the decrease in income taxes payable and deduct it from our balance. So that's going to adjust our net cash provided by operating activities up to $172,000. Here on this slide, you have a nice summary of the adjustments that we've made so far. So this is a summary of conversion to net cash provided by operating activities under the indirect method. So as you can see, we started with the non-cash charges, the depreciation expense, the amortization expense, and the depletion expense. All of these, we're going to add them back. When it comes to gains and losses on disposal of plant assets, if you um, undergo a loss on a disposal of plant asset, you're going to add that back to your statement. And if you had a gain on the disposal of plant assets, you're going to deduct the gain, right? And then changes in current assets and current liabilities. If you have an increase in current assets account, you're going to deduct that. If you have a decrease in current asset account, you're going to add it. And when it comes to liabilities, it's the opposite. So if you have an increase in current liability account, you're going to add that difference to your or adjust the difference in your on your net income. And if you had a decrease in current liability account, you're going to deduct that decrease. And as always, here is a do-it-yourself exercise for the second learning objective. Feel free to pause the video and give it a go on your own. Here we're going to move on to the second step, which looks into investing and financing activities, right? So the company purchased land for $110,000 by issuing long-term bonds. This is a significant non-cash investing and financing activity that merits disclosure in a separate schedule, right? And here on the slide, you can see we have the land ledger account and the bonds payable ledger account showing each of their opening balances and the changes that happened to them during this 2017 fiscal year. And we have the closing balance, of course. So let's see how we're gonna handle this on our statement of cash flows. Here we have a partial statement. So we only got the total from the previous steps that we've done so far, which is the net cash provided by operating activities. And then as you can see, you have the investing activities section and the financing activities section. Don't worry about the information that are here. It's a little bit ahead of itself. We're mainly interested in the bottom line, as you can see, disclosing that the company had issued bonds to purchase a land, and the bottom, which is basically in a separate schedule to the actual cash flow statement that we've been working on. Now going back to some of the details that relate to the investing and financing activities, we also had another piece of information and the additional information that we got in the details of the company, that the company had acquired an office building for $120,000 cash. This is a cash outflow reported in the investing section. Okay, So let's see how is this represented on the statement of cash flows in the following slide. As you can see in red, under the cash flows from investing activities, we have added purchase of a building of 120,000, and of course it's in brackets because it's a deduction. So remember, in your financial reporting, if you reporting a negative amount or a cash outflow, you never put a minus sign. You put the amount in brackets, and that would reflect that this amount was an outflow of cash. Then we also had some additional information that relate to equipment. So the additional information explains that the equipment increase resulted from two transactions. One, a purchase of equipment of 25,000, and two, the sale for 4,000 of equipment costing 8,000. So just a reminder, that would, in the general journal, that would be a debit to cash, a debit to accumulated depreciation of 1,000, and of course the debit to cash is the amount collected from the sale, which is 4,000, and a debit of the loss on disposal of equipment account of the difference between the equipment costs and the sale price with accumulated depreciation. So that would be 3,000. So let's see how is this going to be represented in the statement of cash flows in the following slide. As you can see, if you go down to the two lines in red under the cash flows from investing activities, you're going to see a line for the purchase of equipment showing a cash outflow of 25,000, which is the amount that the company had paid to purchase the equipment, and then another line for the sale of the equipment, which generated 4,000 cash for the company. Now, how about issuing more common stock or common shares by the company? Of course, this is one of the financing methods, so this is going to be under the financing activities section, and issuing common stock for the company is typically or normally, or basically the purpose of that is to get some cash. So that would be added to the financing activities section, right? So let's see how is this done in the following slide. As you can see right here on the cash flows from financing activities, we have a line, the line in red, that states issuance of common stock of $20,000. How about retained earnings? So the retained earnings increased 116,000 during the year. This increase, of course, can be explained by two factors, because, as you know, retained earnings are a little bit more nuanced. So it is affected by the net income of the company positively. So more net income increases retained earnings. And on the other side, the more company pays in dividends is going to decrease the retained earnings. So here, from the information that we got from this company, that they generated net income of 145,000. So this increased the retained earnings. And they gave out dividends of 29,000. So this decreased retained earnings. Okay, so the net change here in retained earnings is 116,000 during this year, right? So let's see how is this going to be reflected on the statement of cash flows in the following slide. Okay, we already included the net income number under the, or started with the net income number in the operating activities section, right? So we're not gonna do that again. That's already been factored in. But as you notice, if you go all the way down to the end of the financing activities section in red, you have the payment of cash dividends, right? And of course, that will be deducted. The amount will be deducted. So as you can see, we have 29,000 in brackets here. All right. Quick review question. Which is an example of a cash flow from an investing activity? Is it the receipt of cash from the issuance of bonds payable, or the payment of cash to repurchase outstanding capital stock, or receipt of cash from the sale of equipment, or the payment of cash to suppliers for inventory? Of course, the answer here is C, the receipt of cash from the sale of equipment. Now we move on to the third and last step, which is basically to just compare the net change in cash on the statement of cash flows with the change in the cash accounts reported on the balance sheet, just to make sure that the amounts agree. And as you can see here, we have the uh, current assets section, and we have the change in um, all the categories or all the accounts under this classification. We have the change in cash of an increase of 22,000, the change in accounts receivable, 10,000 decrease. Inventory was changed by 5,000 as an increase to the inventory, and finally the prepaid expenses have increased by 4,000. So just take those figures and double check them against your changes in the cash flow statement to make sure that these numbers match and there's no discrepancy between the two. And now we get to the third learning objective for today, which is to analyze the statement of cash flows. Of course, this is an introduction to financial accounting course, so we're not going to go very deeply into analyzing a cash flow statement, but one of the um, most important tools that are used to analyze financial or the cash flow statement is what is called the free cash flow. Okay, this is the simple formula that you can apply to pretty much any company to figure out what is the free cash flow, which pretty much just describes the cash remaining from operations after adjustment for capital expenditures and dividends, right? And the formula is as follows, as you can see in front of you: free cash flow equals net cash provided by operating activities as you got from your statement of cash flow. And you're going to subtract the capital expenditures. So you take the items that the company um, or the amounts that the company have spent on um, capital expenditures, and then also subtract any cash dividends that the company have given out. And let's try to analyze a real world company, a company that pretty much I can guarantee that all of you know, which is Microsoft Corporation. This is an old partial statement for the company. This goes back to 2013, a partial statement of cash flows. And all we want to do is to calculate Microsoft's free cash flow. And all the data that you need to do this calculation is presented in the partial statement that you see in front of you. So as we mentioned in the formula before, we're going to start with the cash provided by operating activities, which we have here at 21 um, uh, probably million. I'm pretty sure. I think the numbers here are in thousands or in millions. Yeah, it says in millions on the top, as you can see. So 21 billion 863 million. Less expenditure on property, plant, and equipment, which is the capital expenditure that we talked about. So that's 4 billion 257 million. And we're also going to subtract dividends paid. We can find out the information for the dividend on the last line of the partial statement you see in front of you, the cash paid for dividends, and that was at 7 billion 455 million. So based on that, we can find the free cash flow to be 10 billion 151 million for Microsoft in 2013. That's it. This is the last slide of the last lecture in this course. Thank you guys so much for your time and energy throughout this course, and I hope that you guys have enjoyed doing this course with me. If you have any questions, as always, feel free to leave them down in the comments or to ask me directly, and I'll try my best to answer any questions that you may have. Thank you so much, and who knows, maybe I'll meet you again in another course someday. I wish you all the best in your final exams. I'll hopefully see you again. Take care.